tricking people into being it, and some of it is like forced. Like in America, they ban gold ownership, which is crazy. For like 40 years, Americans could not own gold.
Bitcoin Zella stands out with its simplicity and clarity. We've crafted an experience that anyone can dive into, whether you're a crypto expert or just a new to the crypto world. Now, guess who keeps his eye on us? The author of best-selling book Rich Dad Poor Dad, Robert Kiyosaki. And we want to take this opportunity and thank all the people who trusted us, and we read every comment. And the best part, it's free. Subscribing now means you will get all new information for free. Don't just follow the trends, stay ahead of them. Subscribe to Bitcoin Zella today and enjoy the new edge. Lynn Alden unpacks Bitcoin's future, market forces, and long-term value. Stick around to see where she thinks it's headed.
Is also banks, an unusually high percentage of their assets were treasuries because they were kind of forced into like these public utilities. They were basically there for holding treasuries for a period of time. That was kind of that was like another offset. And so as we look forward, let's say they do cut interest rates, which is certainly possible. If we have, for example, you know, pretty rapid gains in say AI, keeping white collar wages not growing very quickly, and kind of a productivity boom from there, and kind of the way that they choose to measure CPI is not particularly going up very quickly, which gives them levers to kind of cut interest rates. That's certainly possible, but then it just goes back to, you know, you still have the other component, you still have the Social Security component, you still have the Medicare component, you still have the defense component. You still have that whole complex. Interest rates are one of the key factors, but then it goes back to also the prior point of it's a trend change. So even if interest rates don't keep going up, or even if they don't stay at the level they are now, and the important thing is they're not falling anymore. Even if interest rates go back down to say 2% on the short end and 4% on the long end, or whatever the case may be, that's still not an offset. It used to be an offset to the rising debt levels, and now it's just kind of in the static range, potentially. And then in addition, if you do get a much lower interest rate, right now there's this kind of like there's still a hawkishness behind the dollar. So there's a lot of developing countries out there that have dollar-denominated debt. It's something like $18 trillion in dollar-denominated debt. I think of which 13 is like held by non-banks and the rest is held by banks. That's in developed countries, that's in emerging markets, it's kind of all blended. That's part of the Eurodollar system. And all of that represents inflexible demand for dollars. So when the dollar gets kind of strong, it squeezes them. If we do get a much lower interest rate on the dollar, that allows a lot of those other countries to ease their monetary policies as well, because they're not kind of struggling against that strong dollar as much. You potentially get kind of a BRICS boom, or like an emerging market boom cycle. You potentially get higher energy prices from that. Right now, because of the more sluggish global economy, it's one of the factors keeping oil prices pretty much in line. And so that's another factor that can kind of happen. And then at the conference, I highlighted that gold and other scarce assets tend to have this inverse relationship to real rates historically, which is, if U.S. money supply is growing at 7 or 8% per year, most people aren't looking at that. They're looking at CPI, but still, it's growing at a pace. If they feel like they're getting paid 4 or 5%, they're more willing to hold on to that, especially in this kind of regulated environment they operate in. But if they're getting paid 0, 1, or 2%, and that money supply is still growing, they're more likely to get into gold, or in our case, Bitcoin. And so even if we get this kind of low interest rate environment and deficits slow down a little bit, that's still really good for the assets that I'm talking about. And so that's kind of the Wonderland snare we're in now, whereas higher interest rates have one mechanism of accelerating this, and lower interest rates have another mechanism of accelerating this, because it's kind of less of a free lunch now than there was during the structurally declining interest rate environment.
Ethereum just hit a 15-week high, climbing to $2,827 on June 10, and traders are now eyeing the next big milestone, $3,000. The rally follows weeks of sideways movement, and now, with Ethereum futures open interest reaching a record $40 billion, things are getting interesting. If Ethereum climbs past $2,900, it could trigger $1.8 billion in short liquidations, which might fuel a powerful push even higher. One Ethereum whale has already taken full advantage of the rally. Over just 44 days, they made $31 million by perfectly timing 2 massive trades. Meanwhile, activity on the Ethereum network is booming. The number of unique addresses has surged by over 70% in Q2, with the base network leading the charge. Ethereum's DeFi dominance remains strong, holding 61% of the total value locked across the ecosystem. Still, questions remain about sustainability. Fee income is relatively low, and updates aimed at reducing transaction costs have cut into staker returns. With market makers possibly chasing liquidity in either direction, Ethereum could face more volatility. But with momentum building, all eyes are now on that $3,000 breakout.
In developed countries where the liabilities are in their own currency, it's almost always the devaluation option, which and I consider that a default as well. Basically, if you massively devalue bondholders on a purchasing power basis, then that's a type of default. And basically, when you kind of we've gone through this cycle, we keep building up private sector debt. Then it gets so bad that they transfer a lot of it to the public sector. They kind of have this kind of rotation that happens. And when it's all in the public sector, there's really nowhere else for it to go other than default. And if you're an emerging market, you often default nominally because you really just can't acquire the dollars that you pay back, much like a private corporation. Whereas if you're the United States government, you print the difference. And depending on the level of productivity, that will affect how much bondholders even realize that. Because, for example, during the 1950s, 60s period, bondholders weren't exactly complaining, and yet they were underperforming basically anything else. So stock market was going up. Most other asset prices were going up. Bondholders and currency holders were the bag holders. Whereas in, say, the 70s or in the past 5 years, when you have more productivity challenges, the bondholders feel it more. And so it's not basically if there's bad productivity, the bondholders can underperform even basic goods like energy prices, for example. If there's really good productivity, they'll still massively underperform like high quality financial assets that have scarcity to them. Things like gold, Bitcoin, art, best high quality real estate. It still kind of underperforms the things that we're not getting more productive in making, because there's that big spectrum in terms of things that are actually scarce versus things like electronics or textiles or whatever the case may be that we're getting radically more productive in making over time.
Michael Saylor isn't buying into fears of another crypto winter. In a recent interview, he confidently stated that Bitcoin has passed its most dangerous phase and now has one clear path. If Bitcoin's not going to zero, it's going to $1 million, Saylor told Bloomberg, reinforcing his belief that the days of extreme bearish cycles are behind us. His reasoning is simple: demand is rising, while the supply remains incredibly tight. According to Saylor, only around 450 BTC are mined and sold each day, worth roughly $50 million. He believes that if this amount is consistently bought up, the price has no choice but to rise. His firm's strategy holds his staggering 582,000 BTC valued near $64 billion, which underscores just how deep his conviction runs. He also pointed to growing political institutional support. Former President Trump, the U.S. Treasury Secretary, and even big banks are now warming up to Bitcoin. ETF providers like BlackRock are buying daily, and countries like Pakistan are setting up national BTC reserves. Saylor warns that if the U.S. doesn't act soon, it could get left behind. While he admits Bitcoin could see dramatic pullbacks after major gains, his view is clear: Bitcoin's future is bright, and its price could soar far beyond what most expect. If you've been with us so far, a big thank you. Don't forget to subscribe for free to Bitcoin Zella for your daily news. The link is waiting below. That's all for today's crypto news. Stick around for more updates, insights, and analysis on cryptocurrencies. Share your thoughts in the comments, like this video, and subscribe for more exciting content.